Welcome, everyone. This is Araceli, Transition Wealth Advisor and Real Estate Investor in Canada and the US. I am here in my chat with Colette, and we have a special guest. She's a mortgage broker, and she's going to talk to us about some of confusing terms. So, Colette, can you introduce yourself and tell us a little bit what we're talking about today?
Of course I can. Hi, everyone. My name is Colette Rabba, and I am a residential real estate broker in the GTA. Today's guest is Lavinia, the awesome mortgage broker that we love to talk about with her about real estate because she's very knowledgeable. She has lots of clients asking her lots of questions, and we love your questions. We want you to like, subscribe, ask us all your real estate questions that are hard and difficult and easy and you don't know, and we'd love to answer them. So today, Lavinia is going to go through 3 terms with us based on her knowledge about mortgages. So open mortgage, closed mortgage, and a reverse mortgage. So we want to make it nice and easy for you. So Lavinia, welcome, and take it away. What are you going to teach us today?
Thank you for having me. So today, as you said, open mortgage, a closed mortgage, and what's a reverse mortgage, right? Mm-hmm. And so to start off is the open mortgage. An open mortgage basically is a mortgage that can be paid off at any time, and there's no penalty to pay it off. Usually, it's the thing that clients look at it's usually the most common is a 6-month open mortgage.
Okay.
And who normally goes into this is 2 types of people who want to pay off the mortgage. They're transitioning, they want to pay off, they just want for a short period of time.
Sure.
Right. The other type of a client is whose mortgage is coming up for renewal, but the new lender has not closed all the formalities, right? The closing date is past the date of the current mortgage. So that usually it goes into an open mortgage.
Okay.
So that
just is what, like a bridge.
A bridge. Yeah.
Right.
Yeah. Transitioning from one mortgage to the other, right?
Okay.
The other one is a closed mortgage, which is the most common type of the mortgage, right?
Yeah.
Where you have, it's for a certain period of time. And in Canada, we have, say, 1 year to a 5-year term, or a 7-year or a 10-year term, right? And if you want to break that mortgage, then you have to pay a penalty. Yeah. And so the variable and the fixed usually comes under the closed mortgage. The third one is a reverse mortgage. The reverse mortgage is becoming very, very popular now with clients who are over the age of 55. The main advantage of this is there are no payments until the client, as long as the client lives in the property, right?
Okay. And so let's say they move out or they've run out of the money. So the reverse mortgage too, we can talk about the different kinds, but basically a reverse mortgage is not on 100% of their property. A reverse mortgage is someone who has a property, let's say it's worth $1 million, but then based on their age, so the older they are, the more loan to value they can borrow, correct?
Yes. And the main criteria is, number 1, the client has to be at least 55 years of age.
Right.
And everyone on title, say, for example, a client and the spouse, they both have to be at a minimum of 55 years of age.
Okay.
The maximum loan to value is 55% of the appraised value of the property, whatever the appraised. So there will be an appraisal done.
Lavinia, what happens if you do have like a mismatch people that live in the house? Maybe you have somebody that is 55 years old, but their spouse is 35 years old. Let's just say this is a huge difference, but it could happen, right? So
yes. Yeah. So in that case, no, because both of them, whoever is on title, basically, it doesn't matter who lives in the property, but whoever is on title, they have to be at least 55 years of age.
Oh, interesting.
Yeah. And there are certain other requirements as well. Number 1 is the client still needs to pay the property taxes the insurance, and they have to be able to, maintain the property. Right?
Well, and the other thing too is what I find when I tell people about reverse mortgage, they think it's free money, that they're just going to be able to use it. And it's like, no, it's called a mortgage for a reason. It means you have to pay it back. So either you sell the property, or let's say you pass away, and your insurance can cover the rest of the amount of
correct. So that's why it's important to do some estate planning to
exactly
what is happening. If you are going to will that property to somebody, to be sure that they're also can take over, because they have to repay that mortgage.
Right.
But I have a question, Lavinia, because I want to go back into the closed mortgage, right?
Okay.
So you said that the closed mortgage could be between 1, 2, 3, 5 years, and then you jump to 7 to 10 years.
That is the most common.
Correct. And that is that term equals the percentage that you're going to get. So whatever you qualify for, if you qualify for 4, 5, 7%, whatever it is, that's however long you're going to have that term. The payment, it's always calculated on an amortization table, which it could be 25, 30, in some cases 50 years, depending on the price of the property. I just wanted to make that distinction, because sometimes people don't understand what is amortization versus the term of the mortgage. Is that correct, Lavinia?
That's an excellent point, Araceli, because in Canada, in the US, it's different, right? In Canada, the most common terms, like there are two terms, there's a term and there's an amortization.
Yes.
The term is the period of time for which you pay a certain interest. Say, for example, a person buys a home, they will go into a 3-year term, for example, right? So they pay that, if they are in a fixed mortgage, they pay that fixed rate for the next 3 years. If they go for a 5-year term, that whatever rate is fixed for the next 5 years. And so that is a closed mortgage. And then if the client goes in for a 7-year term or a 10-year term, whatever the interest rate is for a fixed rate mortgage, they pay that for the term of the mortgage. Amortization is the number of years the client can take to pay out the mortgage in full. That's the life of the mortgage. In Canada, on the prime side, on the A side, it is either 25 or 30-year amortization. So if a client, the down payment is less than 20%, the maximum amortization, or the maximum number of years that the client can take to pay out the mortgage in full, is maximum 25 years. So, and if the client puts down a down payment of more than 20%, they can take up to 30 years to pay out the mortgage. That's on the A side. Some of the B lenders on the alternate side, they do on a case-by-case basis. They can go up to 35 years. So in Canada, for the most part, it is 35 years. We don't have 50-year amortizations in Canada. There are certain lenders who may go up to 40 years, but that is on a case-by-case basis as well.
Yeah.
But the most common is on the A side is maximum 30 years.
So the reason that I wanted to say that is because depending on the amortization that you pick and the term, then that is going to be your payment. Because if you have a mortgage of $1 million at 25 years, your payment would be higher than if you have a 30-year amortization table, even if you have the same interest. It's based on. Okay. I wanted to clarify, because I have somebody that they didn't know that amortization is different than the term. So that's why I wanted to make sure the clarification is there.
And then that's why I educate my clients on that as well, that, you know, the difference, what is between the term and the amortization. And I also explain that when you extend the amortization, in the longer run, yes, you are paying higher, you know, more interest, because for your amortization, the life is longer, right?
Yeah.
and so that is why that's another it's an advantage, and it depends on how you look at it, but it does reduce your payment if you extend the amortization.
Well, it also depends on how you qualify and for how much. So if you can qualify for a 25-year mortgage, but your payments are high, and you're like, you know what, it would be great if I could just have a little bit more money, you know, spending money for my kids or for whatever I want to do. And then that way you get a 30-year amortization, and your payments are smaller, but at least you have that lifestyle that you have a little bit more money to spend now, you know, for life. Things happen. Roofs need to be replaced, you know.
And that would be also coming back to Araceli about planning and
exactly.
thing, right? And the other thing clients can also do is use their prepayment privileges, because every lender has a certain amount that that the client can pay back every calendar year.
Yes,
and that would go directly to the principal.
Yes,
right.
That's
so
excellent.
It's like
that is an excellent question, and an excellent point, Lavinia, because people need to do their planning. And if you are younger, you have younger kids, you may have more bills to pay, so you want to have a little bit of less mortgage. Maybe you want to have amortization for 30 years for the first 3-year term, and then change it out so you can pay a little bit more and pay your mortgage a little bit faster. But it has to match your lifestyle, because you don't want to be house poor, right? Like paying a lot to your mortgage and not have enough money for your regular expenses. We have to balance those two. So super, super important, right? That's awesome.
And don't forget too, like, even though you have that mortgage rate, you know, the amortization doesn't mean that after the 1 year or the 5 year or whichever the term is, you have to go back to the bank and renegotiate the mortgage too. So who knows after that 5 years, let's just say, what the rates are going to be like. So that's another thing too. All of these things, it's very hard to say specifically for you exactly how it's going to look and how much it is. So that's why we have Lavinia on the show. Reach out to her, ask her your questions, and she'll go through it with you, your number specifically, so she can help you with that.
Well, that's awesome. Lavinia, thank you so much. And remember the terms. So it is open mortgage, closed mortgage, reverse mortgage, and depending on your term, it will be calculated on a different amortization period, which is 25, 30 years mostly. That's what we handle here in Canada. But if you do have a question or you're not sure, please reach out to one of us if you need a question, or you can contact Lavinia directly. She will tell you all about, exactly what you need for mortgage, and she will give you some recommendations for your own personal situation. Remember, all the stuff that we talk about here in the show, it is very general. We try to give you a pinpoint who is a for, but you always have to really talk to the professionals in your own particular situation. So I hope this helps, guys, and we'll see you in the next one. Thank you guys for being here. Bye, Lavinia. Bye, Colette.
Bye.
Thanks, everyone.
Thank you.
Thanks for joining us today. If you'd like more information or if you have any questions, please go to my website at www.coletterabba.com.